In December 1930, a bank in New York called the Bank of United States had a problem that had nothing to do with its finances. A merchant walked into a branch in the Bronx and asked to sell his stock in the bank. A clerk advised him not to. The merchant left the building and started telling people the bank had refused to sell his shares, which he took to mean the bank was broke. By afternoon, several thousand people were standing outside. By the next day, 25,000 depositors had pulled their money out. Within weeks, the bank closed its doors, taking about $200 million of deposits with it. At the time, it was the largest bank failure in American history. The bank had problems. Most banks did in 1930. But the thing that actually killed it was a rumor that started with a misunderstanding in a lobby. That story sounds like an accident of history.
It happens constantly, in every market, in every country, and it follows rules you can predict. Fear does something to money that almost nothing else does. It makes the thing people are afraid of come true. So let's look at how that works. Why intelligent, well-informed people join panics. Why the fastest crashes happen in the healthiest markets. And why no government, no regulation, and no algorithm has ever managed to switch this off. Start with the part that gets misunderstood most. When people describe a market panic, they usually describe it as a crowd losing its mind. Traders shouting, screens flashing red, someone with their head in their hands. The implication is that panic is a failure of intelligence, and that a calmer person would have behaved better. The opposite is closer to the truth. In a bank run, getting in line early is the correct individual decision. Here's why. Banks do not keep your deposits sitting in a vault. They lend most of it out, which is the entire point of a bank. In the United States today, banks hold a small fraction of deposits as cash on hand. If every customer of a healthy bank asked for their money on the same Tuesday, that bank could not pay them. Not because it's insolvent, because the money is inside mortgages and business loans and car payments spread across thousands of borrowers. So the moment you believe that other people are about to withdraw, waiting becomes the worst available option. The people at the front of the queue get paid in full. The people at the back get an announcement. You are not being stupid by running. You are being early. That single feature explains why bank runs are so difficult to stop with reassurance. Telling depositors the bank is fine does not address their actual worry. Their worry is not about the bank. It's about the other depositors. Economists have a name for this shape of problem. In game theory, it's a coordination failure, and it shows up anywhere the right move for you depends on guessing what everyone else will do. Diamond and Dybvig published the classic model of it in 1983, and they won the Nobel Prize for that work in 2022, along with Ben Bernanke. Their argument was simple and slightly disturbing. A bank can have two completely different futures with identical books. In one, everybody expects calm. Nobody withdraws, the bank survives. In the other, everybody expects a run. Everybody withdraws, the bank dies. Same balance sheet, same loans, different beliefs. Nothing about the bank determined which future happened. Now, let's follow how a panic actually spreads, because it rarely starts with anything dramatic. Most crashes begin with something small and ambiguous, a missed earnings target, a hedge fund closing a couple of funds, a price that drops 4% for no reason anyone can immediately name. Here's the problem with ambiguous news. Almost nobody has the time or the information to properly evaluate it. If you own shares in a company and the price falls 7% on a Tuesday morning, you cannot personally audit that company's accounts before lunch. Neither can most professional fund managers who are watching hundreds of positions at once. So people do the reasonable thing available to them. They watch what better-informed participants appear to be doing, and they copy it. Economists call this herding, and it is not a character flaw. It's how anyone navigates a world with more information than time. You do it when you pick the busier restaurant. You do it when you buy the product with more reviews. Borrowing other people's judgment is usually efficient. The trouble arrives when everyone borrows and nobody verifies. Watch the loop that creates. A small number of holders sell for their own private reasons. Maybe they need cash, maybe they're rebalancing. The price ticks down. Other participants see the price ticking down and reasonably conclude that someone knows something bad. They sell. The price falls further, which looks like even stronger confirmation, which triggers more selling. At no point does anyone lie. At no point does anyone need to be irrational. The falling price becomes the evidence for the falling price. Robert Shiller studied this directly after the crash of October 1987, when the Dow lost about 23% in a single day, the largest one-day percentage drop in its history. There was no war, no bankruptcy, no policy announcement that morning. Shiller surveyed hundreds of institutional and individual investors within days and asked what news they were reacting to. The most common answer had nothing to do with fundamentals. Investors reported reacting to the price declines themselves and to what other investors were doing. The crash was largely made of people responding to the crash. Now add the modern machinery, because the 21st century added accelerants that did not exist in 1930. The first is leverage. Investors frequently borrow to buy assets. When prices fall past a certain point, the lender demands more collateral, and the borrower has to sell something immediately to raise cash. Often, they cannot sell the asset that's falling because nobody wants it. So they sell whatever is still liquid, which is usually something perfectly healthy. That is how a problem in one corner spreads into assets that had nothing to do with it. In 2008, funds that needed cash sold gold and blue chip stocks, not because those were bad, but because those were sellable. The second is automation. Roughly 70 to 80% of trading volume in US equities now comes from algorithmic systems. Many of them are programmed to reduce exposure when volatility rises. Volatility rising triggers selling. Selling raises volatility, which triggers more selling. On May 6, 2010, this produced the flash crash. The Dow fell about 1,000 points in minutes and recovered most of it within half an hour. Nearly $1 trillion of market value briefly vanished and came back, and it took regulators 5 years to publish an explanation. The third is speed of information. In 1930, a rumor moved at the speed of a man walking through the Bronx. In March 2023, Silicon Valley Bank lost $42 billion of deposits in a single day, after concerns spread through group chats and social media among a tightly connected community of venture-backed founders. Depositors did not need to stand in a queue. They needed a phone. The bank was closed by regulators the following morning. Same mechanism as 1930. Roughly 1,000 times faster. Underneath all of this sits an asymmetry that shapes what crashes look like. Markets tend to climb slowly and fall violently. Daniel Kahneman and Amos Tversky demonstrated the reason in 1979 with prospect theory. Losses register more powerfully than equivalent gains. Losing $1,000 hurts noticeably more than gaining $1,000 pleases. That asymmetry changes the clock people operate on. Optimism can wait. If you think an asset will rise, missing Tuesday and buying on Thursday costs you very little. Fear cannot wait. If you think you're about to lose your savings, every hour of delay feels expensive. Panic also travels better than calm. A chart with a cliff on it gets forwarded. A careful analysis explaining why the cliff is temporary does not. By the time the reassuring argument has been written, checked, and published, the fear has already been around the world twice. Which brings us to the part that makes market panics genuinely different from other kinds of mistake. In most systems, a false belief eventually meets reality and loses. You can believe your car has a full tank, and the fuel gauge will settle the argument. Reality does not care what you think. Financial markets do not work that way, because in a market, the belief is part of the machinery. If enough people believe a company is finished and sell, the share price collapses. A collapsed share price makes lenders nervous, so credit gets more expensive or disappears. Suppliers ask for payment up front. Customers hesitate to sign long contracts with a company they've read is in trouble. Talented staff start interviewing elsewhere. None of that was true on Monday. All of it is true by Friday. And it became true because people acted as though it already was. The prediction did not describe the outcome. The prediction manufactured it. This is why the response to a financial panic so often consists of words rather than money. When central banks and governments intervene, the first move is usually a statement, a guarantee, a promise of unlimited support. In July 2012, with the euro under severe pressure, Mario Draghi said the European Central Bank would do whatever it takes to preserve the euro, and added that it would be enough. Borrowing costs for Spain and Italy fell sharply over the following months. The program he was referring to, outright monetary transactions, was never actually used to buy a single bond. The sentence worked. The spending was not required. That tells you something uncomfortable about what financial value rests on. A large portion of it is collective agreement. The agreement is remarkably solid, while everyone assumes everyone else will keep agreeing, and it can dissolve in an afternoon when enough people suspect the agreement is ending. Nothing physical has to change. The factories still exist, the loans are still owed, the confidence just left. So, can any of this be prevented? Partly. Deposit insurance was created precisely for this, and it works. The United States introduced federal deposit insurance in 1933, after roughly 9,000 banks failed during the preceding years. If your deposits are guaranteed up to a limit, you have no reason to join a queue, so the queue never forms. Circuit breakers now halt trading on major exchanges when prices fall by set percentages, forcing a pause into a process that feeds on speed. Central banks act as lenders of last resort, standing behind institutions that are solvent but temporarily short of cash. All of these help. None of them removes the underlying problem. Because the underlying problem is not a flaw in the system, it's a feature of people. As long as your best move depends on what you expect everyone else to do, there will be moments when expecting the worst is the smartest available choice. Silicon Valley Bank happened in a country with deposit insurance, sophisticated regulation, and decades of institutional memory. Most of the money in that bank sat above the insured limit, so the guarantee did not apply to the people who ran. The instinct that causes bank runs is the same instinct that makes you glance at the exit when a crowded room gets tense. It is not greed, and it is not stupidity. It's the entirely sensible desire to not be the last person out of the door. Which means market panics are less like a disease to be cured and more like weather. You can build for them, insure against them, and predict some of the conditions that make them likely. You cannot legislate them out of existence because they are made of us. So, what do you think? Have you ever sold something in a panic and regretted it later? No judgment here, most people have. Tell me below. If this made things click, subscribe. Every week, Otto breaks down how the world actually works. Next time, why focusing has become almost impossible, and who benefits from that. See you then.